Let's talk about how you can build serious wealth without working until you're 70. Welcome to Passive Income Journey 777. Today, we're diving into fantastic investing ideas tailored for the future. We're talking actionable strategies to get on the fast track to retiring rich. I want to give you a complete blueprint of investing ideas suited for today's market conditions. We'll cover the bedrock of a solid portfolio to modern approaches that leverage technology. This is about smart, calculated moves that build sustainable, long-term wealth. The key is consistency and knowledge. It's about understanding the principles, staying disciplined, and letting your money do the heavy lifting for you over time. So make sure you watch until the very end because each idea builds on the last. Alright, first up, and this is honestly the foundation for probably 90% of all successful long-term investors, we have to talk about index funds. If you take away only one thing from this entire video, let it be this. Index funds are, without a doubt, one of the most reliable, efficient, and low-stress ways to build significant wealth over time. For anyone who's just starting out who feels overwhelmed by the stock market, this is your answer. An index fund is basically a giant basket that holds hundreds or even thousands of different stocks, all bundled together for you. It's instant diversification. By purchasing a single share of an S&P 500 index fund, for example, you instantly own a tiny piece of the 500 largest companies in the United States. Because they are passively managed, the fees are ridiculously low. So for any young professional who wants a set-it-and-forget-it strategy, this is it. Just let it ride for the next 30 or 40 years. Low fees are your superpower as an investor. Imagine two people investing $500 monthly for 30 years, both earning 8% annually. One uses a low-cost index fund, 0.04% fee, the other an actively managed fund, 1% fee. This seemingly small fee difference has a colossal impact. After 30 years, the low-cost investor has $745,000, while the other has only $610,000. That's a $135,000 difference vanished due to fees. This is the silent killer of investment returns. Choose low-cost index funds from providers like Vanguard, Fidelity, or Schwab. Warren Buffett advises sticking with low-cost S&P 500 index funds. Focus on consistency and minimizing costs. A total stock market or S&P 500 index fund is enough to build wealth. Alright, let's move on to our second fantastic idea, and this one is for everyone who's ever dreamed of owning real estate but got immediately shut down by the thought of needing a six-figure down payment. We're talking about real estate crowdfunding. This is a relatively new and incredibly powerful way for young professionals to get a piece of the real estate market with very small amounts of money. Think about it. Traditionally, if you wanted to invest in a large apartment complex or a commercial office building, you'd need to be an accredited investor with millions of dollars. It was a club that most of us were completely locked out of. But now, thanks to technology and platforms like Fundrise or Realty Mogul, that's all changed. These platforms essentially act as a middleman. They go out and find large-scale professional real estate deals, like building a new 200-unit apartment building or buying a portfolio of single-family rental homes. Then, they pool money from thousands of small investors, just like you and me, to fund the deal. This means you can invest as little as $10, $100, or maybe $1,000 and become a part owner in a massive income-producing property that you could never afford on your own. You get the benefits of real estate ownership without the headaches. The best part is that this is a truly passive investment. You aren't the landlord. You will never ever get a call at 2 a.m. about a clogged toilet or a broken furnace. The crowdfunding platform and their professional real estate partners handle all of that. The property management, the tenants, the maintenance, the paperwork, everything. Your role is simply to invest your capital and then collect your share of the profits, which typically come in the form of quarterly dividends from rental income and potential appreciation when the property is eventually sold. It's a way to add the stability and cash flow of real estate to your portfolio without any of the typical landlord responsibilities. This strategy is perfect for diversifying your investments beyond just the stock market. We all know the saying, don't put all your eggs in one basket. Well, if your entire net worth is in index funds, it's all in the stock market basket. Real estate often behaves differently than the stock market. When stocks are down, real estate might be stable or even up, and vice versa. By adding a slice of real estate crowdfunding to your portfolio, you're creating a more balanced and resilient financial foundation that is less susceptible to the wild swings of any single market. which is a very smart move for long-term financial security. With any investment, we have to talk about the risks. The biggest thing to understand about real estate crowdfunding is liquidity, or rather, the lack of it. This is not like a stock that you can sell in seconds. Your money is typically tied up for the duration of the project, which could be 3 to 10 years. The rewards, however, can be quite attractive to compensate for that lack of liquidity. Many of these platforms target annual returns in the range of 8% to 15%. You are taking on more risk than those safer assets, but you are also being compensated with the potential for much higher returns. Real estate crowdfunding is ideal for the young professional who is now looking to diversify into alternative assets. Start small, understand the platform, and never invest more than you can afford to lose. Let's explore dividend growth stocks. When you buy a stock, you own a tiny slice of that business. Some companies share profits with shareholders through dividends. Dividend growth stocks are champions that consistently increase dividends. Imagine a company increasing its payout by 7% annually. Your income grows without you lifting a finger. This creates a snowball effect, turning small dividends into a powerful passive income stream. Reinvest dividends to buy more shares, amplifying future payments. It's a virtuous cycle that accelerates wealth accumulation. A simple way to build a massive portfolio over time. Look for companies with a wide economic moat, a strong competitive advantage that protects them from competitors. These companies often increase their dividends for many consecutive years. A great place to start is the Dividend Aristocrats list. The beauty of this strategy is its dual benefit: passive income and potential capital appreciation. Remember that investing in individual stocks carries risk. That's why diversification is crucial. Aim to build a portfolio of dividend growth stocks across various sectors. Dividend growth investing is a marathon, aligning with building long-term wealth. By starting today, even with a small amount, you can plant the seeds of a massive financial tree. Okay, so we've talked about real estate crowdfunding, but let's say you want an even simpler, more liquid way to get a piece of the property market. Maybe you love the idea of earning income from massive apartment complexes, sprawling shopping malls, or giant industrial warehouses, but you have absolutely zero interest in dealing with tenants, toilets, or termites. Well, for that, we have our fourth fantastic investing idea, REITs, which stands for Real Estate Investment Trusts. And let me tell you, these are one of the most ingenious financial inventions for the everyday investor, because they completely democratize real estate investing for literally anyone with a brokerage account. So what exactly is a REIT? Think of it like a mutual fund, but instead of holding a basket of stocks, it holds a portfolio of income-producing properties. These companies own, operate, or finance real estate across a huge range of sectors. We're talking about everything from the apartment building down the street to the data centers that power the internet, to the cell towers that give you a signal, to the hospitals where you get your checkups. By buying a single share of a REIT, you instantly become a fractional owner of all the properties in its portfolio. It's the closest you can get to being a commercial real estate mogul without needing millions of dollars and a team of lawyers. Here's the part that really makes REITs a fantastic tool for passive income investors, and it's actually required by law. In order to maintain their special tax status, REITs are legally obligated to pay out at least 90% of their taxable income to shareholders in the form of dividends. That's right, 90%. This is a massive number, and it's the reason why REITs typically offer some of the highest dividend yields you can find in the entire market. This structure ensures that as an investor, you are directly benefiting from the rental income and property appreciation generated by the REIT's portfolio, creating a consistent and substantial stream of passive cash flow. The best part is the accessibility. Unlike buying a physical property, which involves mortgages, down payments, and closing costs, you can buy and sell shares of a REIT on the stock market just as easily as you can buy a share of Apple or Tesla. This provides incredible liquidity. If you need your money back, you can sell your shares in seconds during market hours. This flexibility, combined with the professional management and instant diversification across dozens or even hundreds of properties, makes REITs an incredibly powerful and hassle-free way to add the benefits of real estate, income, diversification, and inflation protection to your investment portfolio without any of the traditional landlord headaches. Now, not all REITs are created equal. Just like with stocks, they come in all shapes and sizes, and it's important to understand the different types before you invest. You have equity REITs, which are the most common type. They own and operate properties directly, generating income primarily from rent. Then you have mortgage REITs, or MREITs, which don't own physical properties but instead provide financing for real estate by originating or investing in mortgages and mortgage-backed securities. And finally, you have hybrid REITs, which are a combination of the two. For most beginners, focusing on equity REITs is generally the simpler and more stable approach. Within equity REITs, there's a whole world of specialization. You can invest in very specific sectors of the real estate market based on what you believe has the most growth potential. For example, you have residential REITs that own apartment buildings and single-family homes. There are retail REITs that own shopping centers and malls. Industrial REITs own warehouses and distribution centers, which have boomed thanks to e-commerce. You even have highly specialized REITs that own things like data centers, self-storage facilities, or senior housing. This allows you to tailor your real estate exposure to specific economic trends you want to capitalize on, all from the comfort of your couch. Just like with dividend stocks, diversification within your REIT holdings is key. You wouldn't want to be invested only in retail REITs right before a massive shift to online shopping, or only in office REITs right before a global pandemic makes remote work the new normal. By spreading your investment across several different types of REITs, say a mix of industrial, residential, and healthcare, you can protect yourself from downturns in any single sector. An even easier way to achieve this is by investing in a REIT ETF, or exchange-traded fund, which holds a diversified basket of dozens or even hundreds of different REITs in a single, low-cost investment. This is a fantastic set-it-and-forget-it option for most people. So, to wrap it up, REITs offer a compelling package: high dividend income, liquidity, professional management, and instant diversification across the vast real estate market. They allow you to earn passive income from rent checks without ever having to screen a tenant or fix a leaky faucet. Whether you're a young professional just starting out or a seasoned investor looking to diversify, adding REITs or a REIT ETF to your portfolio is a simple and effective strategy to build wealth and generate a reliable income stream. It's one of the smartest ways to get the benefits of being a landlord without any of the work. High-yield savings accounts and certificates of deposit, or CDs, are arguably the most important foundation of your entire financial life. Their primary job is protecting your capital and providing liquidity. There's a huge difference between a traditional savings account and a high-yield one. Traditional accounts pay next to nothing in interest. A high-yield savings account, or HISA, is a game-changer, offering much higher interest rates. The primary role of your HISA is to hold your emergency fund. This is your oh-no fund, preventing you from selling investments at a bad time. Earning interest in an HISA helps your emergency fund keep pace with inflation. These accounts are also FDIC insured, meaning your principal is completely safe. Now let's talk about the cousin of the high-yield savings account, the certificate of deposit, or CD. A CD is a savings product that holds a fixed amount of money for a fixed period of time, such as 6 months, 1 year, or 5 years. In exchange for you agreeing to leave your money untouched for that entire term, the bank pays you a fixed interest rate that is typically even higher than what you could get in a high-yield savings account. It's a trade-off. You sacrifice a little bit of liquidity for a slightly better guaranteed return. This makes CDs an excellent tool for specific short to medium-term savings goals. For example, let's say you know you're going to need a down payment for a house in 2 years. You don't want to risk that money in the stock market, because the market could crash right when you need to buy. But you also don't want it sitting in a regular savings account earning nothing. This is the perfect scenario for a 2-year CD. You can lock in a great interest rate today, and you know with 100% certainty exactly how much money you will have at the end of the term. It removes all the guesswork and market volatility from your short-term financial planning, providing peace of mind. One strategy that people use to maintain some flexibility while still taking advantage of higher CD rates is called a CD ladder. This sounds complicated, but it's really simple. Instead of putting all your money into a single 5-year CD, you would split it into 5 parts. You'd put one part into a 1-year CD, one into a 2-year, one into a 3-year, and so on. Then, as each CD matures each year, you can either use the cash or reinvest it into a new 5-year CD. After a few years, you'll have a CD maturing every single year, giving you regular access to your cash while still earning the high interest rates associated with long-term CDs. Ultimately, both high-yield savings accounts and CDs are about playing defense with your money. Your investments in stocks and real estate are your offense, designed to grow your wealth significantly over the long term. But a strong defense is what wins championships. These safe, insured accounts provide the stability and liquidity your financial plan needs to survive any market condition or personal emergency. They are the bedrock upon which you can confidently build your investment portfolio, knowing that your immediate needs are secure. So before you go all in on the next hot stock, make sure your financial safety net is firmly in place. It's the least exciting but most crucial step you'll ever take. Let's talk about peer-to-peer lending, or P2P lending. Imagine you could become the bank, lending directly to individuals or businesses. The appeal is higher returns than savings accounts or bonds. But remember, higher returns mean higher risk, primarily default risk. Unlike bank deposits, P2P lending isn't FDIC insured, making diversification essential. Platforms offer tools to assess risk, grading borrowers based on credit history. Spread your investments across many loans to mitigate the impact of defaults. Getting started with peer-to-peer lending is straightforward. You begin by choosing a platform, creating an account, and linking your bank account to transfer funds. Once your money is in the P2P account, you can start browsing available loans. You can see details about the loan's purpose and the borrower's anonymized financial profile. Most platforms offer an automated investing feature, which is perfect for beginners. You can set your investment criteria, for example, to only invest in loans with certain risk grades. For those who want a more hands-on approach, you can manually filter and select individual loans. For most people, a hybrid approach works best. It's an excellent way to add diversification away from the stock market and potentially boost your overall returns. But because of the inherent risks, it's wise to allocate only a small percentage of your total investment capital to it. Make sure your index funds, real estate, and dividend stocks are solid and running smoothly first. It's an exciting tool, but one that must be used with caution. Let's discuss what I believe is the most powerful investment: investing in yourself. It's a concrete financial strategy. Every dollar spent increasing your skills and knowledge can pay you back 100-fold. It's the ultimate asymmetric investment. Your downside is limited to the cost of a course, but your upside is unlimited earning potential. Invest in things that increase your value. This is critical in today's economy. The only way to future-proof your career is through continuous learning. Investing in yourself is your hedge against irrelevance. This investment compounds, making you eligible for better jobs and creating a snowball effect on your income. So, how do you actually put this into practice? The first step is to do a personal skills audit. Be brutally honest with yourself. Look at job postings for positions that are 1 or 2 steps above your current one. You are creating a roadmap for your own professional development. Identify the 1 or 2 skills that would provide the biggest boost to your career trajectory. Next, you need to budget for your education, just like you would for any other investment. By earmarking this money, you transform it from a random purchase into a deliberate strategic investment in your future self. The internet is filled with incredible, often free, resources. Set aside specific time in your calendar each week to work on your new skill. Consistency is what turns learning into mastery. Finally, don't forget about soft skills like communication, negotiation, leadership, and networking. We've covered index funds, real estate, dividend stocks, peer-to-peer lending, and high-yield savings. These are powerful tools to build the financial future you've dreamed of. The most important takeaway is the urgency of action. Your journey to financial independence starts today with one small, manageable step. Do your own research, understand the risks, and set a deadline. Take concrete action this week. If you found this valuable, hit that like button, subscribe, and let me know which idea you'll try in the comments. Thanks for watching, and I'll see you in the next video.